Welcome to our channel. In today's video, we'll be diving into a key financial concept, the annual return. Whether you're an investor, a business owner, or simply someone curious about how your money grows, understanding annual return is essential. We'll break it down step by step from what it is, how to calculate it, and why it's important for your investments. So, let's get started. What is annual return? First things first, what exactly is an annual return? In simple terms, it's the percentage increase or decrease in the value of an investment over a one-year period. Think of it as a way to measure how much money your investment has made or lost in a year. Annual return is used across a wide range of investments: stocks, bonds, mutual funds, and real estate. It helps investors assess how well their money is performing and compare it to other investment opportunities. Whether the return is positive or negative, it shows the rate at which your investment has either grown or shrunk over the past year. Here's a basic formula for annual return. It's calculated by taking the difference between the end value of your investment and the start value, then dividing that difference by the start value. Multiply that by 100 to express it as a percentage. Why is annual return important? Annual return such an important metric? Simply put, it helps you measure the performance of an investment. It answers the critical question, how much money am I making on my investment every year? Investors often look at annual return to compare the performance of different investments. For example, if you're considering investing in a stock versus a bond, knowing the annual return can give you insight into which is more likely to give you higher earnings. If one investment has an annual return of 5% and another offers 10%, you can immediately see that the latter might be more attractive, assuming the risk is similar. Of course, higher returns often come with higher risk, so it's crucial to consider that as well. How to calculate annual return. Now let's walk through an example of how to calculate the annual return on an investment. Imagine you invest $1,000 in a stock, and after 1 year, the value of your investment has grown to $200. How do you calculate the annual return? In this case, your annual return would be 20%, meaning you earned 20% on your original investment in just 1 year. Pretty straightforward, right? But what happens if the value of your investment decreases? Let's say your $1,000 investment drops to $900 after 1 year. The formula would look like this. This means you had a negative return of 10%, indicating a loss. Compound annual growth rate, CAGR, versus simple annual return. Now, while simple annual return gives you the percentage change for a single year, what happens when you're looking at an investment over multiple years? That's where compound annual growth rate, CAGR, comes into play. CAGR calculates the average annual growth rate over multiple years, accounting for compounding. Basically, the return on your returns. It smooths out the growth over time, giving you a clearer picture of long-term performance. For example, let's say you have an investment that grows 5% in the first year, 10% in the second year, and then declines 2% in the third year. Simple annual return would just look at each year individually, but CAGR gives you an overall growth rate that averages the ups and downs. So while simple annual return is great for single-year analysis, CAGR is more reliable for long-term performance, giving you a more accurate measure of an investment's true growth. Real-world application of annual return. Now that we understand the basics, let's look at some real-world applications of annual return. One common use is in retirement planning. When you invest in a 401k or an IRA, you want to know how much your money will grow each year. Knowing the annual return on your investments can help you estimate how much you'll have when you retire. It's also crucial for portfolio diversification. Investors want to mix different asset classes, stocks, bonds, real estate, each with different annual returns to optimize their risk and reward balance. By comparing the historical annual returns of various assets, you can create a balanced portfolio that aligns with your financial goals. For example, real estate tends to have a more stable but lower annual return compared to stocks, which can be volatile but often offer higher returns over the long term. Risks and limitations of using annual return. However, it's important to note that annual return doesn't tell the whole story. While it's a useful metric, it doesn't account for risk, volatility, or market fluctuations. For example, An investment that has a 15% annual return might look great on paper, but if that return is the result of extreme price swings, it could be a risky choice. This is especially true with investments like tech stocks or cryptocurrencies, which can have incredibly high annual returns but also come with high levels of risk. Always make sure to look at the bigger picture, including the investment's volatility and overall risk profile. Annual return versus other metrics. While annual return is an important metric, it's not the only one investors use to measure performance. You might also hear terms like return on investment, ROI, which calculates the total percentage of return from the time you invest until the time you sell, regardless of the time frame. Net profit is another, which focuses more on the actual dollar amount you gain after subtracting all costs. The key is to use annual return alongside these other metrics to get a fuller picture of how your investment is performing. Each metric tells a slightly different story, and together they give you a more well-rounded view. To sum up, the annual return is a crucial metric for evaluating the performance of your investments over a one-year period. Whether you're looking at stocks, if you need any information, comment down below. Don't forget to like and subscribe. See you in next video.